and all that stuff was blowing up, and everybody thought everything was going to keep going up. And it doesn't mean that it can't keep going up, because on average, asset prices do go up. But the problem is that at some point it could go down, and it does go down, and things crash, and people don't expect the crash, and then they're all shocked and blown away. And you should never get to the point where you don't think that the market could crash. You should never get to the point where you aren't sort of weighing every possible scenario in terms of what can go wrong, what can occur. How do you, let's see, next question is from Tiana. Tiana says, how do you set up the call and put option orders in Robinhood and ETrade? Can you share and show the step by step? Yeah, you know what, we did a lot of these examples in class. So if you log in, just go to drboyceprime.com. And if you have any trouble finding any of the materials in the class, just message support@theblackbusinessschool.com. That's support@theblackbusinessschool.com. And we have a great support team that will answer any questions and show you, guide you to whatever you're looking for. Chanel also comes to class every time we meet for class, and she's there as kind of a liaison to make sure that, or concierge-ish kind of role, where she basically, as the director of the Black Business School, make sure you find access to whatever you need, get all your questions answered. So if you want to know everything that's in the Prime program, just go to drboyceprime.com. And I want to remind everybody, we just started working more with Telegram as opposed to YouTube and some other places, because we kind of wanted a space that allowed us a little bit more range to do things. So just go to drboycetelegram.com. You can join our Telegram group. Let's see here. Rafael Galva, continuation of my original question. If I'm able to make 97% ROI or profit in a week or a year, 97% is a high ROI. Theoretically, I've done that in a year. I've never done that in a week. Well, actually, I probably have at some point with some crazy stock that went berserk. But for the most part, that's not really reasonable. That's not usually going to occur. So, and anybody that sort of guarantees that this kind of thing can happen is probably lying to you. Again, anything's possible, but you don't want to invest sort of hoping for the most extreme outcomes. You want to invest sort of expecting the average outcome. And so the average outcome sort of means, that you're going to chug away, get your, maybe if you're lucky, get 8 to 10% per year and consistently do that. Now, in terms of selling call options, things like that, the ROI can be higher. But as we talk about in class, you have to be really careful, and you have to be prepared to stomach volatility. If you cannot stomach the volatility and you don't protect yourself from the downside carefully, then you can end up getting burned pretty bad. And so, because I don't want you to be burned, I don't want you to have unrealistic expectations when it comes to investing. So don't let yourself get caught up in that with that sort of quick money mindset. That stuff almost never works. That's the stuff that people throw you on the internet to get you to do strange stuff. All right, so 97% ROI. If you take the ROI of selling call options every week, it can be as high as 97%. But again, it requires you to, we talk about this a lot in class, and there are examples we've done. If you log in at drboyceprime.com, you can see some of the examples that we've done. We've done a billion of them, just to show you sort of what I do, because you really have to think it through. You can't just assume that this is going to be the natural outcome. You have to be prepared for the possibility that you could lose money. And that's just really true with all investing. Never ever let anybody make you think that investing isn't something that could lose you money, because it can always lose you money. Let's see here. Raphael, if you sold 10,000 shares, 20,000 in a week, whichever example, you wish to use, how are you expanding the same 10,000 shares throughout the year? You know what? And you say at the 50M mark. I don't know what 50M means. 50 million. Sorry about that. Let's see here. How did you get 110 options sold? 1.1. Is this the premium 1% increase? Are you selling above the strike? I don't understand the whole question, Raphael, so maybe bring that to class. But I will say that I tend to sell, when I sell my calls, I sell out of the money call options, because I don't like to give up all my upside, but I'll sell some of the upside in order to get income from that. So that's something that that you may want to consider. All right, let's see. Picola Brown says, can you give an example of a call option in Snap and describe what I should look for in a chart? Snap was not on our list. If you log in to drboyceprime.com, you can see the Dr. Boyce moneymakers that are things that I'm actually selling options on. Snap is not a company that I feel comfortable with at this point. One thing I could say is, Snap The reason Snap kind of fell off the radar for me is because not only is Snap a company that is having operational issues, and I know why. To some extent, it's because of how they run their company. They don't really care much about their shareholders. But the other thing too is the stock just had a lot of volatility for the amount of income you could generate by selling the call. So I took Snap off the list. Let's see. Donna says this may be a little bit beyond class, but can you briefly explain how to buy stocks at a discount? Selling put options. This may be feasible when trying to buy stocks as low as possible. Yeah, yeah. So one of the things that I do too is I'll sell put options on stocks that I actually want to own. One of the opportunities that's presented in the stock market is that sometimes a stock price will drop, at least appear to drop below its fundamental value. And but so that gives you a buying opportunity. So if you have a good company that you want to get a hold of, and you've decided in advance that that's a company you want to be a long-term investor in, then you can sort of sell those puts and make income from that. And then when the stock drops, you come in and you buy the stock. You're going to buy it at a discount or at a price lower than the current price. That's the upside. The downside, though, is that the price may drop far below your strike, which means that you have to buy the stock at a price that's above the current market price. So in a way, this is how companies get acquired, actually. The way companies get acquired is they don't typically pay the market price for the company. They pay the price, they pay a premium. Almost every single transaction. Anytime a company acquires into the company, they almost never pay what the company's worth on the market. They'll have to pay a little bit of a premium because what they're kind of basically saying is it's like dating. It's like somebody saying, I want to date your girlfriend and I can treat her better than you, right? Which is kind of a weird thing to say, but it's true. It's a weird analogy, but it's true, right? She's not going to want to switch boyfriends unless she really believes that this new boyfriend is going to be just substantially better than the old one, right? Because if they're both the same, then why would you leave one and go to the other one, right? So basically, companies or investors do the same thing. Whenever a company wants to acquire another company, they go to the shareholders who are the owners of the company, that would be you, and they say, hey, your stock is trading at $80 a share, we'll pay 84. And the shareholders say, okay, that sounds good. I get to make money. I can either cash out or I can hold on and see what happens depending on what the deal looks like. And then you move on, right? So buying a new company requires a certain amount of risk. And what you're basically arguing from a financial standpoint is that you can allocate that capital better than other people can. It's like when Essence Magazine got sold, and this is why a lot of black-owned businesses get sold. Time Warner saw Essence as a property and said, okay, you're making, 20 million a year from Essence. If we blend Essence with our existing portfolio of magazines, we can actually make, 50 million a year or whatever. So based on that new higher revenue amount, they were able to bid an astronomical amount of money for Essence, which was almost like an offer that the owners could not refuse. I think I met one of the previous owners of Essence, and he told me how much money it was, and I said, yeah, that's a lot of money to walk away from. And so, so if you're thinking about the transaction purely on a financial basis, instead of thinking, well, it's important for the black community to own certain media outlets. But if you're just thinking about the money, typically comes in pretty high, especially for black-owned businesses that are doing well. It becomes what I call the Jackie Robinson effect, where they look at a Jackie Robinson who's toiling away in the Negro Leagues, and maybe he's making, $80,000 a year, and they say, well, we could bring this guy in and pay him $300,000 a year because we can justify it because we have a bigger audience and more reach and more capital, so we can get more out of that asset, right? Because an athlete is an asset. So the same thing is true when you're talking about buying stock. That's why one company buys an asset from another company, because they feel like they can actually get more out of that asset than somebody else. All right, so last question I'll answer, and then we're going to bounce out. Donna C says, is there a way to sell cover calls without giving up my stock? Yeah, one of the, remember the 10% rule we talked about in class, where I keep 10% in cash in case the stocks go past the strike price. The 10% in cash is available to put out fires. That's either to prevent FOMO or FOLO. FOMO is when the stock goes up and you feel you have the fear of missing out and you're mad because you could have made more money than you actually made because you sold some of your upside. The FOLO is when the stock price drops and you're kind of mad because your equity value has dropped. So having the cash available allows you to deal with things like margin calls, or when the price shoots up way up, you can go back and buy some of those shares back and maintain ownership. It kind of depends on how you want to deal with it. And I give you a range of options in class. So I'm going to reach out to you guys soon for another class meeting. So just go to drboyceprime.com if you'd like to see some of the stuff that we've been doing in class, and then we can kind of go from there. All right, guys. So have a good one, and I'll talk to you soon. So you'll hear from me soon. Don't forget, follow us on the Telegram channel. On Telegram, we have the Black Investors Group, and that's a daily conversation about Black wealth and Black economics. So the URL that should link, it should work. Hopefully, it's propagated and everything. drboycetelegram.com. If you go to drboycetelegram.com, it redirects you to our Telegram channel, and you can sort of follow, just get sort of that daily investing input on a regular basis. All right. So I'll talk to you soon.